Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 11th of January. I'm Daniel Lam, your host for the podcast. Personally, I've always been interested in technical analysis, but I believe it is more relevant for certain asset classes. For example, technical analysis may work better in FX because of FX sheer depth in liquidity and its diversified spectrum of users compared to other asset classes. Now currently, the DXY, i.e. the US dollar index, is having a very intriguing picture. For those who have been long-term followers of Cut to the Chase, you will recall how I like to look at the relative strength index, i.e. the RSI, and compare that against the level of the underlying. Now, the DXY index made a low at the beginning of 2024, but its RSI did not. This indicates diminishing strength in the selling of the US dollar, a sign of potential rebound. Now after that, the DXY did go higher by 2%. It is now consolidating around the 102.5 level and may challenge the initial resistance at 103 and perhaps to the next resistance levels at 104 and 105.5. Now, how persistent would this rebound be? Well, momentum indicators such as the MACD and the ADX are both showing bullish crossovers, which suggests that the rebound in the US dollar may have further room to go. Now, this has a support from positioning indicator as well. Historically, the DXY index usually performs whenever it crossed a crowded short level. For example, minus 1.5 standard deviation from longer-term average. A period of consolidation, such as what we are seeing now, is likely to follow, and then buy a squeeze higher. Now, looping back in macro fundamentals, this is connected with what we've been discussing in the podcast earlier this week, that expectations of Fed rate cuts and the timing of such may have run ahead of itself somewhat over the last 2 months of 2023. And therefore, we may see a period of healthy pullback in the first quarter of this year, which gives opportunities for investors to be adding onto long duration trades, such as US growth stocks and DMIG government bonds, because we do believe that the US economy would be slowing down to induce Fed rate cut later this year. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.